And everything that's good economics is bad politics. And everything that's good politics is bad economics. That's the underlying problem with democracy and why they're usually as violent in their deaths as they are in their births.
Hey everyone, my name is Liam Cosgrove. I'm a business reporter with the Epoch Times, and today I'm joined with Peter Schiff. He's going to give us his 2023 outlook. Peter Schiff is the chief economist and founder of Europe Pacific Asset Management. Peter, thanks for joining us today.
Oh, thanks for having me on.
Peter, what we've had 1 week in January so far, and not really a whole lot going on in markets. What do you expect to happen from here?
Well, actually, quite a bit has gone on. First of all, look at the strength that we've seen in gold. In fact, gold stocks are already up about 11% in the first 4 trading days of the year, although today, the fourth day isn't even over yet. We'll see what happens. But we've seen some incredible strength in gold mining stocks. They have continued their stealth bull market. Many of these stocks are up 40, 50, 100% from where they were 4 or 5 months ago. So this is a big move. And during that same period of time, by the way, the NASDAQ has actually gone down. So the stocks that everybody owns are going down, and the stocks that nobody owns, except a few people, are going way up. And they're going up in relative obscurity, which likely means the rally is going to continue, because as long as it's not on anybody's radar, you don't have to worry about any kind of meaningful pullback. So I think it's very encouraging as a gold investor, as a gold stock investor. Also, the dollar is starting off the year weak, which is the way it ended the prior year. And I think 2023 could end up being one of the weakest years ever for the US dollar. I think a lot of people piled into the long dollar trade in 2022 based on Fed tightening and the idea that the Fed was going to continue to ratchet up rates to bring down inflation, and that got a lot of people into the dollar. I think what's going to get them out of the dollar in 2023 is the realization that the Fed is going to give up its inflation fight, not because it wins, but because it loses. And it's going to focus attention on the economy, which is going to be in an even deeper recession. And I think in 2023, the recession deniers are going to finally have to admit the truth. And there's going to be a lot of pressure on the Fed to stimulate the economy, especially when we see a big increase in unemployment, which we haven't had yet, but which is coming. But the only stimulus the Fed has in its tool chest is inflation. That's all it's ever had. The only thing the Federal Reserve does when it wants to stimulate the economy is create inflation. Except the problem is now that inflation is the problem. And you can't solve a problem by creating more of the same problem that you're trying to solve.
Okay, interesting. So you think 2023 is the year the Fed pivots and the market wakes up to that reality. And you think this first week is kind of a bit of a realization that realization is showing itself in gold stocks maybe right now?
Yeah, I mean, gold stocks are going to do very well in an environment where the Fed is pivoted. And even if the Fed doesn't make a full pivot, it doesn't have to cut rates. It just stops hiking them. But I think more importantly, it would be quantitative tightening. If it slows down the pace of QT or actually goes back to QE, that is going to be, rocket fuel, I think, for gold. Because, the markets were pricing in this big reduction in the Fed's balance sheet. And I think the Fed is going to be even less successful shrinking it this time than it was the first time it tried. Remember, that when the balance sheet got to 4 trillion, they were supposed to bring it back down to 1 trillion. And I don't even know if they got below 3 trillion before they cranked it up to almost 9 trillion. And it's going to be harder to shrink a $9 trillion balance sheet than it was to shrink a $4 trillion balance sheet, especially when they're trying to shrink it in a much more highly levered up economy.
So you talk about the tech stocks that everyone right now is selling. If the Fed were to pivot, a full pivot, go back to QE, why wouldn't the tech stocks rally too? Why wouldn't are those cheap now? Would people want to get into those? Why is gold going to do better?
Well, the tech stocks are not cheap. In fact, despite a rather significant decline, they remain expensive. But I don't think that the next bubble is going to be in the same assets as the past bubble. So when the Fed tries to reflate this economy, I don't think they're going to reflate the tech bubble. We had a tech bubble 20 years ago in the late 1990s, and then we had another one more recently. But I think that this next time, the money is not going to flow into that sector. And I think one of the main reasons is going to be inflation. I think that tech stocks were part of the low inflation story. Low inflation meant low interest rates, and that meant that companies that were growth oriented, that weren't expected to deliver profits until many years into the future, when interest rates and inflation were low, investors were willing to wait, and they were willing to pay up for the prospect of a big payday in the distant future. But now, with the cost of waiting so much higher, not just the nominal interest rates, but the inflation rate, if money is really losing value much faster than 2% a year, you don't want to wait 10, 20 years to get your money. Who knows what it's going to be worth by then? So I think investors are going to be looking for stocks that can show them the money right now. So it's not companies that are promising earnings in the future. It's companies that have earnings right now and can deliver those earnings to shareholders in dividends, and dividends that can go up with inflation. People are going to be looking for the stock market as an inflation hedge to get out of bonds, to get out of cash. And they want real companies. They want companies with pricing power. That's important in an inflationary environment. You have to be able to raise your prices without destroying your sales. Now, a lot of companies are not going to be in that position. When they raise their prices, their buyers are going to go away. And in fact, even if they don't raise their prices, if your customers are spending a lot more money on food, on energy, on insurance, on rent, on taxes, and they have nothing left over, then it doesn't even matter if you cut your prices. You don't have any customers. So a lot of companies that have been living off of the discretionary income of the consumer, especially when the consumer had a lot of home equity and could tap into it, or had the ability to buy now and pay later, had all kinds of credit, they could run up their credit cards. A lot of companies lived off of that. Well, they're going to die by that as well when the consumer can no longer avail himself of that credit.
Okay, and in terms of the real economy, if the Fed were to pivot, I guess interest rates would go back down again. They would start printing money, and that in recent history has gone mostly into financial assets.
It won't do it this time because, the last couple of times the Fed was able to orchestrate the pivot, right? It did it when inflation was 2% or less than 2%. And that provided the cover for the Fed. Hey, it's okay to do this because we have really low inflation. In fact, it's too low. And so we can kill two birds with one stone. We can stimulate the economy and get closer to our 2% inflation goal because we're going to stimulate the economy with inflationary monetary policy, which they claimed we needed. Of course, we needed it like a hole in the head because we don't need 2% inflation. Plus, it wasn't even 2%. That's only because they lied about it. They had a lie to get it to below 2%. It was actually probably 4%. And now, of course, it's double digit, although they won't acknowledge double digit because of the way the index is rigged. But my point is that let's say that we're back in recession, maybe even a financial crisis. We're seeing it in a small scale play out right now in crypto and blockchain, right? You're seeing all the dominoes, one company after another going bankrupt, freezing accounts, because everybody owed everybody else money. And there was so much counterparty risk. And it's this, and so everything is kind of imploding. But so far, it's kind of isolated, to the crypto. Yeah, you got Bed Bath & Beyond came out yesterday and they're filing bankruptcy. Of course, that was a meme stock, got to $30 a few months ago. Now it's barely $1, right? But, you're mainly seeing this, collapse in crypto, although there's still a long way to go down because, Bitcoin is still trading above 16,000. So the people are still in denial in the HODL gang. But what I think is going to happen is as higher interest rates work their way through the economy, you're going to see more problems in the credit markets blowing up, and it's going to be outside of crypto. Because remember, the mortgage crisis started with subprime. And when the Fed was out there saying, oh, don't worry, it's contained to subprime, I was saying, no, subprime is the tip of the iceberg. We're just seeing it in subprime first. That's the weakest link in the chain. But we're going to see it in the rest of the mortgage market. So we're seeing the credit problems first in crypto because that's the weakest link. But you're going to see broader problems throughout the economy because we've had 0% interest rates for more than a decade. You can't build up that kind of drug addiction and then all of a sudden rates are 5% and there's not massive withdrawal. So let's say we have another financial crisis, we're in a deep recession, but inflation hasn't come anywhere near 2%. I mean, maybe it's not 8%, maybe it's 4 or 5%, right? That's still well north of the Fed's so-called target. So what happens if in an environment where inflation is already double or triple the Fed's target, but then the Fed gives up the inflation fight and says, no, we got to stimulate the economy, and they stimulate the economy by creating even more inflation. Well, now they're throwing gasoline on a fire. And so now a high inflation rate gets even higher. And in that environment, I don't see financial assets as a group doing well. So I think bonds get killed. Instead of going up with QE, they actually go down. Long-term interest rates go up, which is going to be a huge problem. High multiple companies that lose money, these prices continue to fall. The stocks that go up are, again, the real businesses. That's why the Dow Jones was the strongest of the major indexes last year, because it has the most value, even though, on a relative basis, there's not a lot of value there. I mean, in an absolute basis, but relative to the S&P or the NASDAQ, there's better value in the Dow. Now, there's even more value, outside the United States. I mean, that's why, for example, our investment strategies, our two main strategies, dividend and value, both had positive returns in 2022. And, they weren't huge returns, but we were in the black, and that's huge when everybody else is down 20, 30, 40%. To be up a couple of percent is a big achievement. And what made it even more difficult was that the US dollar was still up about 10%, and all of our stocks are foreign. So they had to go up 10% just to break even. And so our stocks did better than that. But I think 2023 is going to be an even better year for my investment strategy. I mean, I think it just could be phenomenal if we hit it on all cylinders, which I think we will, which will be a falling dollar, which is a big tailwind. But then we continue to see the rotation from momentum to value, and we're just loaded up with value and dividend payers. And I think the next rotation, which has just started and people aren't really paying attention yet, is from developed markets to emerging markets. And so, we've got good positions there. So I think we're set to where the money's going to be. I've been set for a while now. I've been anticipating this rotation for a long time. So it's a long overdue. But I'm here, and I am welcoming what's going to happen, I think, in this year from an investor's perspective. I think from an American perspective, I'm not welcoming anything, because I don't think any of this is a positive for the U.S. economy or for most Americans. I just think it's positive for my clients, and me in particular. I'm my biggest client, so I think I have more to gain than anybody from this strategy playing out.
Interesting. So one thing you said that piqued my interest there was so you're saying that treasury bonds will get killed, but did you mean treasury bonds? You think even the long-term treasury bill, if they go back to QE, it'll still get killed even though the Fed's buying it because inflation?
Yeah, well, because the only way the Fed can buy.
You don't think they'll do yield curve control and keep it pegged to a certain yield or something like that?
Well, if they try to do that, the more they try to keep yields from rising, the more money they have to print to buy those bonds, which means the more inflation they create, which means the less attractive the bonds they're buying actually are. So the more bonds they buy, the more bonds they have to buy. And so they can't solve this problem. But if they really can succeed in keeping, let's say, long-term interest rates below 4%, which is where they are now. They're, in the mid threes, right? If they do succeed in doing that, it's going to be because the Federal Reserve buys them all, But then whatever bonds the Fed is not buying are going to be, collapsing in price and soaring in yield. So they may be able to keep the Treasury yields below 4%, but they're not going to keep municipal bonds below 4%. They're not going to keep corporate bonds unless they start buying those things too, and mortgages and all that. But the more they buy, the more they have to buy because the more everybody else wants out. And if the Fed is there with a big bid in the market and the Fed says, we will overpay for your bonds, sell us all your crap and we'll overpay for it, well, everybody is going to hit that bid. But that just makes the inflation problem much, much worse. So, the Fed has put us into a box and there is no way out. And I've been warning about this for more than a decade. I knew exactly where we would end up. I just didn't know how long it would take to get there, or maybe the exact route we would take, but I knew where we would ultimately end up, and that is exactly where we are.
And so from a philosophical perspective, with the Federal Reserve, because also what you mentioned about how they might buy corporate bonds, they did a little bit of that. They bought some like corporate bond ETFs and during the COVID crisis. If it gets to that level and every crisis we're just papering over more and more with the Federal Reserve, from your philosophical perspective, because I know you're an Austrian, what is your solution to that? Do you think we should have never had QE? Should we just not have a Federal Reserve to begin with? What's the Peter Schiff solution to this?
Yes, we would be better off had we never created the Federal Reserve in 1913. But, it's possible that we could have created something even worse. So there's no way to know for sure. Maybe if we had a bunch of parallel universes that we could take a peek and see how they all worked out. But the way they originally envisioned the Federal Reserve wasn't that bad. The problem is they changed it, and because the original Federal Reserve Act, the Federal Reserve wasn't even allowed to buy U.S. Treasuries. It was prohibited by law from even owning them. And of course, the original Federal Reserve notes were backed by gold. 40% gold, 100% commercial paper. And the mission of the Federal Reserve was to have an elastic money supply. And what that meant was when the economy expanded, they would expand the money supply along with the economy. But then when the economy contracted, they were supposed to contract the money supply. But we don't do that. We do the opposite of that. What the Fed does now is when the economy is strong, they expand the money supply. And then when it's weak, they expand it faster. Right, so it's not elastic.
When that switch occurred, when did we start doing the exact opposite of the initial,
I don't know exactly, but certainly probably during the Depression, everything started, with Roosevelt in the 30s and then really kicked into gear in the 60s with the Great Society programs and the war on poverty and the Vietnam War. And, that's why we had the big outburst of, price inflation, in the 1970s. And it's going to be worse now. In fact, I think the last year or two was already worse than the worst of the 1970s, because when they go back and say, hey, inflation was 10, 11, 12% in the 70s, and it's only 7, 8% now, that's apples to oranges because the CPIs are different. If you took the 1970 CPI and you used it to calculate the CPI today, you had the same metrics, we would have had 15 to 20% inflation last couple of years, much higher. Or if you took our CPI and brought it back and redid the 70s numbers using the CPI of today, they would have had inflation maybe no higher than 6, 7%, something like that. So we're already worse, but we're just getting started. And you remember, the way they were able to bring that inflation to an end was Paul Volcker in 1980, who allowed real interest rates to get to a positive 6 or 7%. The highest inflation got was 1981 at 13.5 by CPI, and we had interest rates at 20. We're nowhere near there. We're still got interest rates half the inflation rate. And where's the cuts to government spending? You're not going to rein in inflation without getting to the source of inflation, which is government deficit spending. We just passed this omnibus Freudian slip, omnibus spending bill. That's all financed by inflation. You can't fight inflation and create inflation at the same time. So I don't see any end in sight to the inflation spiral that's only only now just getting started. And that's why it's so important that people act to protect themselves, because the vast majority of people are going to get eviscerated by what really amounts to a tax. I mean, this is how the government is paying for all the programs, all the spending. We're not getting anything for free from government. Everything government gives you costs money. And the way most people are going to pay for the cost of government is through higher prices. And we've only seen the beginning of the price increases that are coming.
So you mentioned the importance of fiscal spending there, and the Great Society, LBJ's big welfare push being partly to blame for the inflation, and then Reagan's welfare cuts helping to rein it in. So let's say Jerome Powell, holds true and keeps raising interest rates, but then President Biden, continues various stimulus programs, unemployment, welfare things. In that sort of scenario, could you get rising inflation, rising CPI, despite interest rates also rising, given what the fiscally what.
Sure. Again, remember, interest rates are another price too. I mean, if I'm a business, I've got raw material costs, I got labor costs, I got rent, and I got interest if I've borrowed money. And as my interest rates are going up, I mean, that's another cost that I'm going to look to pass on to my customers through higher prices. So all else being equal, rising interest rates are adding to the inflation problem. The way rising interest rates are supposed to slow inflation is by slowing spending and increasing savings. That's what has to happen. But that hasn't happened. If you look at consumer consumption patterns, they're spending like crazy. The savings rate is near an all-time record low. It has collapsed. And credit card debt, mortgage debt, auto debt, student, all-time record high. So the rising rates have done nothing to alter consumer behavior. And so they're going to do nothing to bring down inflation. The only thing that's happened is we've had a pullback in commodity prices, oil prices, other things that moved up the most, the quickest, they've pulled back. And so that's creating some hope that maybe we've seen the worst of the inflation and now it's coming back down. But no, those prices are going to consolidate and hit new highs, probably even this year. And the other thing that's causing some hope is that real estate prices are finally coming down. But that doesn't matter, right? Real estate prices are not even part of the CPI. What's part of the CPI? Owner's equivalent rent. So, and that still has a long way to go up. But the other factors that are there, utilities are in there, insurance is in there, maintenance costs are in there. All those things are going to go up. So even if the price of a house goes down, let's say a house that was $400,000 comes down to $300,000. It's actually going to be more expensive to buy the $300,000 house than it was to buy a $400,000 house a couple of years ago, because the mortgage rate is much higher, your insurance cost is much higher, your maintenance, your property tax. I mean, all the costs of home ownership are going way up. And Americans, most of them, they don't buy the house. They buy the monthly payment. Doesn't matter what the house costs. What matters is what do they have to pay every month to live there? And that's going to go way up, even as prices go down. And of course, the falling prices creates a big problem for the people who own homes, who have borrowed against the homes, or a big problem for banks who have loaned against those homes. And now the homes lose value. And the guys that live there don't want to stay there. And now they have to sell these homes in a market where mortgage rates are way up. And so people can't afford to buy them. So it's a real disaster that's coming in housing. But it's not going to reduce inflation. Inflation is going to go up even as the economy goes down.
Okay. And I know you're a big gold guy. What are some other ways to hedge against inflation? What other investments are you guys making? Energy stocks?
We're investing in international stocks. The foreign stock markets are off to a pretty strong start so far in 2023, and I think that's going to continue. There's going to be some bumps, especially as we get some big drops in the U.S. market that will pull down the foreign markets. But I think overall, the foreign markets will buck that trend. And I don't know how much the U.S. market is going to lose. I think we're going to make new lows in 2023. I think we're going to take out the 2022 lows. But by the second half of the year, if the Fed is back at QE, that could put some type of floor beneath the broader averages. And so maybe we could end the year a bit higher, but we could also end it quite a bit lower. But I think adjusted for inflation, I doubt the stock market will beat inflation. And I think the stocks that most people own, like the FANG stocks, those stocks are going to go down. I think they're going to have another bad year, just like they had a bad year in 2022. I think they're going to have another bad year in 2023. But I think the international stocks, the stocks that we're buying that benefit from inflation, and there are a lot of companies that are positioned to do that. We own those stocks, and I think their prices are going to keep going up. Many of the stocks that we own are hitting 52-week highs this week, and headed higher. And I think, in particular, some of these gold names, I mean, they're still well below their 52-week highs. That's how much they went down in the last year, but they're miles above their 52-week lows. So they're in really big bull markets, but they're still very cheap. They still have a long way to go to get to fair value. That's the opposite of the tech stocks. The tech stocks are still very expensive, and they have a long way to fall to get to fair value, let alone cheap. The gold stocks still have a long way to rise to get to fair value. In fact, they can rise a lot and still be cheap. I think that's how inexpensive they are. So there's an opportunity. And, ironically, you had a lot of people who were worried about inflation, worried about the Fed, worried about the dollar. But instead of buying gold, they bought Bitcoin. And they're also going to lose a lot of money in 2023. I mean, Bitcoin was down 75% or so in 2022. It could be down that much again in 2023. It could be down more. And of course, a lot of people are losing all their Bitcoin because they put it with a custodian that went bankrupt. So in which case, your Bitcoin is already worthless if you don't have it. But even the people that still have their Bitcoin are going to lose money because the Bitcoin itself is going to lose its market price. Because that's all it has, right? Bitcoin has a price. It actually has no value, but it has a price as long as people are dumb enough to buy it. But eventually, people wise up. They're not going to stay dumb forever.
I do have a Bitcoin question for you in a minute. One thing I did want to ask is, so it's been part of your thesis for a while. Kind of the Federal Reserve has been central to your investment thesis for a long time. But nowadays, almost everyone you hear on TV, CNBC or whatever, the Fed is basically the primary. What the Fed is going to do is primary to their investment thesis. So this is kind of another philosophical question. Like, what does that do to the market when, what was the original purpose of the stock market? And does everybody betting on what the Fed's going to do kind of distort the purpose of what investment is meant to be, giving money to promising companies, whereas now it's just kind of a betting game on what these guys at the FOMC are going to do?
Yeah, look, the Federal Reserve has turned the market into a casino, and it's really helped undermine the productivity of the American economy, which is one of the reasons why we have huge trade deficits and the economy is so screwed up, is because of this bad foundation. And the Fed should be irrelevant. Nobody should be making investment decisions based on the Fed. But right now, the Fed is the only thing anybody cares about. Like, are they going to raise rates? By how much? Are they going to do QE? I mean, the fact that everything is riding on the decision of a few guys sitting in a room in Washington, D.C., that's not how capitalism is supposed to work. Right? And if you think about what these guys do, they sit in a room and they decide the price of money. They decide the quantity of money. Why? Why should they make these decisions? I mean, that makes no more sense than having a bureau put together to decide the price of oil or the price of milk or the price of bread. Why don't we do that? Why don't we have government bureaucrats figuring out what prices should be? After all, wouldn't it be better if, some prices were lower? Why don't we set the price of oil at 50 cents a gallon, right? That'd be great, right? It'd be a lot cheaper. Because we can't do that because it creates distortions. It creates problems. We know that we have to let the market discover the price. We just can't set the price. That's what the Soviet Union used to do. And it was a disaster because you waited in line for 4 hours to get, you didn't even know it was at the end of the line. You just waited in it if you saw it because you figured maybe there was something you needed. And what was there? Maybe they had rotten apples, but rotten apples were better than no apples. So you waited in line for 4 hours to get some because, they were cheap, but you spent a lot of time getting them and they weren't very good. So we know that. We know that we shouldn't fix prices. Yet everybody thinks that it's a good idea to let government bureaucrats pick the interest rate. Why? I mean, you've got to figure that since money is half of every transaction and interest rates are really the price of money, the government is basically fixing every transaction we make. That makes no sense. If you believe in capitalism, then you don't believe in the Fed. And when the Fed creates problems, when it creates booms and busts, you can't blame that on capitalism, because under capitalism, there is no Fed. This is the government. This is socialism. We have socialized that market function of interest rates. And we've got all the distortions that you would expect whenever you have price fixing. What do we have a shortage of? We have a shortage of savings. We have a shortage of real goods production. What do we have a surplus of? Debt, consumption, speculation. There's bubbles everywhere. These are not happening by accident. They're happening because of the Fed. And so they need to take a step back and undo all the damage that they've done. Now, that can't be done in isolation, right? In order to do the right thing, there's going to be a lot of short-term pain, which is why we never do the right thing. Politicians don't want short-term pain, even if it leads to long-term gain, because they don't care about long-term gain, because they may not be in office if we have the short-term pain. So what they would rather have is less pain now, even if it means more pain later.
So one thing interesting you said there is that interest rates are the price of money, and most people do think the Federal Reserve is a good idea. They think it's a necessary function. However, most people also agree with what you said about fixing the price of bread and milk. Most people learn the lesson from the Soviet Union and say, oh, we don't do that because it would create shortages. I guess with money, it's harder to intuitively understand. If you're setting the price of money, what is it that you're getting a shortage of? I guess you said it comes in the form of savings.
Right. Well, think about interest rates, because it's the cost of money is time preferences, right? I'd rather have my money today than in a year or in 5 years or in 10 years. There's a cost of money. And that is going to be determined by all the individual time preferences in an economy. And we have to allow that rate to be discovered so that we can have an adequate interest rate to have a healthy balance between savings and borrowing. Because some people have to want to save their money. When you save your money, you're deferring your consumption. I'm not going to buy something today. I'm going to buy something tomorrow. But I'm going to get paid to wait. I'm going to get paid interest to defer my consumption. And the level of savings is what's supposed to determine the level of capital investment, because there's savings to support it. But all of that is turned on its head when you have, basically a Politburo saying, no, we're going to set interest rates at 1%. And the way you know that the rate is too low is just looking at how low our savings are and looking at how much debt everybody has. When you have low interest rates, everybody wants to borrow because it's cheap to borrow. When you have low interest rates, nobody wants to save because you're hardly getting anything for savings. So we're punishing savings, so we have less savings. We're encouraging debt, so we have more debt. The government needs to be neutral. The government should not be putting its thumb on the scale. And the way you do that is the government just steps back. The Federal Reserve can say, look, we're not going to set interest rates. We're going to let the market figure out what the right interest rate is. I mean, that's how interest rates got to 20% under Paul Volcker. It's not like Paul Volcker said, what's the rate we need? I'll go with 20. He just kind of stepped back and took his thumb off the scale, and that's where rates went, right? Now, they didn't stay there that long. They gradually came down, but it was the market that brought them down. It wasn't Volcker. But that's what we need. The Federal Reserve needs to say, look, we're not buying bonds anymore. We're out of that business. And we're just going to see where rates go. And we're going to shrink our balance sheet. And here's what we're doing, because they got to do that. And just let rates go up. Problem is, rates are going to go way up, which they need to. They need to go way up. That's the solution to the problem. But of course, that creates another problem. It's like, if you are a heroin addict, what is the solution to your heroin problem? Stop doing heroin. But when you do that, you're going to go through withdrawal because you're not going to have that heroin high anymore. But okay, yeah, it's going to be tough. You got to go through that, go into rehab, And then when you come out, you're in better shape. Well, if the Fed lets interest rates go up, we're going into economic and monetary rehab. It ain't going to be fun, but when we come out, we'll have a sound economy, right? But instead, every time the economy looks like it's getting ready to go into rehab, the Fed gives it more drugs, so it doesn't have to go, right? But that's the problem. We never correct the problems. We just keep making the problems worse, which means our ultimate stay in rehab is that much longer and that much, more painful, because by the time we get there, we're so screwed up because we've gotten so much drugs in the system that it's very difficult to get off.
So to piggyback on your heroin analogy, I think one of the common criticisms of your solution is like, if we were to raise interest rates super fast or just have no Fed, let the market set them, that heroin addict might, die from withdrawal. So it's like, if you didn't have like, especially now with how indebted the economy is, would the bankruptcies be so bad? Would the layoffs be so bad that you would, society might break down?
Well, look, they will be very bad. They're going to be worse than had we done the right thing, let's say in 2020 during COVID, or had we done the right thing in 2018 when, the Fed pivoted the last time, had it not pivoted, or had we done the right thing in 2008 after the financial crisis, or had we done the right thing in 2001 or 2002, or had we done the right thing in 1995. I mean, every time the Fed kicks the can down the road, the cost of doing the right thing goes up, right? So because we keep doing this, yes, now it's going to be even more painful. But the argument that, well, we can't do it now because it's so painful just means that when you do it, it's even more painful. But what happens if we never do it, right? So, well, it's so painful, we're just never going to do it. Well, then you die of an overdose, right? Okay, and so what would be the equivalent of a monetary overdose? That's hyperinflation, right? And under a hyperinflation scenario, we just destroy the value of our money, right? So, and that's the worst way for this to end. But that's how it's going to end unless we do the right thing. But again, it's going to be a lot more painful to do that now than it would have been had we done the right thing in the past. The longer we wait to do the right thing, the more painful it is, which means the more reluctant people are to do it. Oh my God, we can't possibly allow that to happen. Well, yeah, that's what they said 10 years ago. We should have, because it would be over by now. But again, these guys have short time horizons. It's the next election. They don't give a damn about the country. That's the problem. The people running the country couldn't care less about the country. They just care about their political career. And everything that's good economics is bad politics. And everything that's good politics is bad economics. That's the underlying problem with democracy and why they're usually as violent in their deaths as they are in their births.
So also at the sovereign level, where you talk about if interest rates did keep going up, at a certain point, the U.S. would have a solvency crisis where we couldn't pay back all the debt that we owe.
Well, we can't pay back the debt. The problem is going to be, can we service it? Paying it back is impossible, right? I mean, I
guess nominally you could, but you would have to print so much that it would be worthless.
Yeah, it would be worthless. So it's the same thing as default. It's we inflate it away. But the only reason we were able to pay the interest on the debt was because the interest was practically zero, so that we could afford. We can't afford 5%. If the Fed keeps rates at 5% long enough for the entire national debt to roll over, which it will over the next few years, and let's say the national debt goes to 40 trillion and interest goes to 5%, that's $2 trillion a year just to pay interest on the national debt. Now, I mean, where is the government going to get that money? That's like half of all the taxes the government collects. And that's at 5% interest. If interest rates go to 10%, interest payments on the debt will consume 100% of what the government collects in taxes or something like that, which, obviously we're beyond the point of no return, right? And so the only way the Fed can keep paying the interest on the debt is if rates go back down, because if they stay up, it's impossible.
Wow. So that was 2 years at 5%. Is that what you said? Just 2 years at 5% brings us to 2 trillion?
No, I said if the national debt gets to 40 trillion, right now it's what, almost 32 trillion. Mm-hmm. So when it gets to 40 trillion in a few years, if interest rates stay at 5% and the whole debt rolls over, and now we got to pay 5% on 40 trillion, That's 2 trillion a year.
Okay,
But even long
assuming
before
the
that,
entire debt is serviced at 5%.
yeah, we're going to get to 1 trillion a year probably this year. I mean, it's going to be the biggest line item in the budget, other than maybe Social Security, Medicare. I mean, we're gonna probably pay more in interest than we're paying for national defense. We're certainly going to be paying more for interest than education or welfare combined, or a lot of these other things. But eventually, interest is going to be the only thing we're spending money on. The U.S. government is simply going to be, a conduit from collecting taxes and paying interest, right? There's not going to be anything left for it to do. So obviously, it's going to have to collapse before it gets to that point. And the most likely way it's going to collapse is inflation. Because if inflation is bad enough, let's say there's so much inflation that prices go up 10 times. Everything is 10 times as expensive. Let's say at the end of this decade, something that costs $100 now costs $1,000. Let's say that's what happens, right? Well, if the national debt is, let's say, 40 trillion or 50 trillion, it will feel like it's only 5 trillion, because in relative terms. So that's how you wipe out most of your debt. You can't repay the debt, that's impossible. So you just repudiate it through inflation. You just screw your creditors by paying them back in money that has a lot less value. Because there's the honest way to default, which is, we can't pay you back, so we're not going to do it. We're going to give you some kind of haircut. So if you own U.S. Treasuries, we'll give you 50 cents on the dollar or 40 cents on the dollar or something like that. But no politician wants to be honest and admit that we're broke. So instead, they just print a bunch of money and say, hey, everybody gets paid back. Here's all the money you loaned us. Yes, when you loaned us this money, you could have bought a car with it. And when we're paying you back, you can only afford a pack of chewing gum with the same amount of money, but we paid you back, right? We didn't default. Here's your money. But the key is what the money will buy. Having money that buys nothing is like having no money.
Okay, so you're saying the right way to solve that solution, if you were in charge, what you would do is you would either default or partially default on most of the debt, because that would be the best way to go about it.
If you want to know the right solution to the problem right now, is we let interest rates go way up, let a bunch of companies go bankrupt, let a bunch of businesses fail, free up the capital and their labor to be reallocated. But what the government needs to do is fess up in that environment and say, you know what, we have way too much debt, we can't pay it back, so we're just going to have to give everybody a haircut. And it won't be that bad. I mean, let's say I own U.S. Treasuries, and I used to have $1 million worth of Treasuries, but now I have $500,000 worth of Treasuries. I still could be better off than people that own stocks or real estate. I mean, when I go to buy stocks or real estate, I might be able to buy more stocks and real estate, because those prices will actually go down more than my bonds. And the cost of living might go down. So I have less money, but I need less money, right? So it's not as big a disaster for the bondholders to get back 50 cents on the dollar, whatever it is. But also, the government has to be honest with other creditors, like people who are expecting Social Security, Medicare, government pensions. The government has to say, we don't have any money to make these payments, so we're going to have to means test it, or these are the people that we're going to reduce your Social Security benefits. You're not going to get what we promised. So there's got to be a reduction in the size of government across the board. Everybody's got to be told the truth that they're going to get less. But since that's not going to happen, it's going to end up being much worse for our creditors. It's going to be much worse for the people on Social Security. They're not going to get their benefits cut. They're going to get paid benefits that buy nothing. So the real reduction in their benefits is going to be even greater. So instead of, let's say, losing half your benefits are going to lose 90% of their value, and that's worse. And of course, the way I would cut Social Security, the people that need it the most would get the least cuts. And wealthy people would have the most cuts, or they would, like for instance, me, right? I should get no Social Security. I know I paid in a lot, but I should get nothing, okay? But if you just don't default on anybody, then everybody is going to lose through inflation. I'm going to lose the same as a guy that is dependent on his Social Security, which, that's not the best way to do it, is to spread the losses out evenly so that the Warren Buffetts, suffer as much as, the truck driver. My way is a better way of doing it. Be honest and try to kind of target where the pain is felt. But going forward, after we do this, we got to get rid of Social Security. We got to eliminate it. We get no more, so that future generations aren't dependent on an intergenerational government-run Ponzi scheme. We have to allow the free market to work. We have to get the government out of a lot of things. Get the government out of education. No more student loans. No more guaranteed student loans. Get the government out of housing. No more government guaranteed mortgages. Get it out of banking. No more government insured bank accounts. We need to go back to a free market. If we want real prosperity, then we need a real free market. And we can't have a free market with the government micromanaging everything and distorting all the markets with subsidies and taxes and regulations that make the economy a lot less productive than it otherwise would be. And it forces everybody to accept a much lower standard of living than what they would enjoy if we didn't have all this government.
Okay, so if people want to prepare for inflation, let's go back to an asset that some people think is an inflation hedge and you do not, which is Bitcoin and other cryptos. Why, from like a more abstract standpoint, why is Bitcoin or any cryptos, why are they not an inflation hedge in your view? Aside from just performance of the last year, like, fundamentally, why are they not inflation hedges?
Well, so when you talk about a hedge against inflation, what exactly are you hedging? So during inflation, prices go up. And the price of the things that you need to buy go up. Food, energy, stuff like that. So the way you would hedge against inflation is, instead of owning the dollar, which is being inflated, you would own an asset or a commodity that would rise along with the price of everything else, so that in the future you could use that commodity to buy your food or to buy your energy. Now, you don't have to directly use it. You could sell it, and now you have an appreciation, and then you have more money to buy more expensive food and more expensive energy. Now, one thing you could do is just, well, I'm going to buy next year's food today. That's how I'm going to hedge inflation. I'm going to go and buy all the food that I expect to eat next year. I'm going to buy it right now. Except some of the food might rot. It might not have a long enough shelf life. You might not have enough room in your house to store a year's worth of groceries. Same thing with energy. You can't just go out and say, I'm going to buy all the gasoline I'm going to need for the next year. Okay, where are you going to put it? Right? So gold, the reason gold's a great inflation hedge is I can go out and buy an ounce of gold or whatever I need, and I could just put that in, in a shoebox somewhere. It's not going to rot. It's not going to decay. And as long as the price of gold rises along with the price of everything else, right, then I'm hedged somewhat. I'm even. Right? Now, the reason Bitcoin can't be an inflation hedge is because Bitcoin in and of itself isn't a commodity. Gold is a commodity, like oil, like wheat or soybeans or copper. Gold is a commodity that has a price. And its price is a function of supply and demand. And what do people use gold for? They use it for jewelry, right? Here's a gold watch, right? You can make jewelry out of it. You can conduct electricity and put it in a chip and make a cell phone, or dentists could take the gold and make a crown. NASA uses it in aerospace. There's all sorts of demand for gold that set a price. And if you go back and you look historically over the last 10 years, 50 years, 100 years, 1,000 years, you can see a relationship between the price of gold and the price of everything else, right? So, and so if all prices are going to go up, well, then why wouldn't gold prices go up? They would. Bitcoin is used for nothing, right? There is no history beyond 12 years. So you can't say, how much should oil be in Bitcoin? How much should wheat be in Bitcoin? Who the hell knows? But meanwhile, what is the demand for Bitcoin in the real world? There is no demand. All the demand for Bitcoin is simply, I want to buy it because I think it's going to go up. Okay, yeah, it's got speculative demand, but that's the only demand it has. It doesn't have real world actual demand. There's no actual user that is going to be buying Bitcoin. In fact, you got miners that are going to be selling Bitcoin. So there are natural sellers. There's just no natural buyer. And so how could it be a hedge against inflation? The price could be anything. The price is not a function of the price of milk or the price of oil or the price of wheat or even of really money supply. It's just a function of, do people want to buy Bitcoin or not? How the hell do you know? Maybe people will want to buy it, and maybe they won't. But that's not a hedge. That's a speculation. Now, there are people that say, well, maybe people will buy Bitcoin as an inflation hedge. Yeah, maybe they will, but they'd be stupid to do that because it's not an inflation hedge. If you want to bet on other people being stupid and mistaking Bitcoin for an inflation hedge, but the people who are buying it aren't buying it for an inflation hedge. Nobody is buying Bitcoin because they think, well, I think inflation is going to be 6% and I'm expecting 6% gain on my Bitcoin. No, they're expecting Bitcoin to go to the moon. Inflation hedges aren't going to go to the moon. Why would they go to the moon? Not unless everything else goes to the moon. So it doesn't have any of the characteristics that would make it a viable inflation hedge. And, again, it's down 75% last year. And inflation was, 8%? So, adjusted for inflation, you lost better than 80%. I mean, I can't think of pretty much anything worse than that. So how does that qualify it as being a hedge against anything when it can fall that much in such a short period of time? And in fact, Bitcoin has only been around for about 12, 13 years, and it's had, I don't know how many, 4, 5, 6, whatever, 70, 80% declines during that short period of time. So, I mean, it's anything but stable or safe or conservative. It's not a hedge. It is the ultimate speculation. So I think as more and more people wake up to that, and of course now, the regulators who have been asleep for a while, there's been a lot of fraud, obvious fraud that's been going on in the space. And we don't need new laws or new regulations. I mean, theft, Sam Bankman-Fried, what did he do? He embezzled money. He stole money. That's illegal. It's been illegal for 100 years. We don't need new regulations. We just need the police to enforce the regulations that already exist. But we also need more personal responsibility. People have to be a little bit more thoughtful about where they put their money. They have to do their homework and do better due diligence. But that hasn't happened while everybody's been high on the Fed drugs, right? And while everybody assumes the government is going to protect us, and I know because of Sam Bankman-Fried, and now you got other things. Look what's happening with Alex Mashinsky. Now he's being sued by New York. For Celsius, they're saying, oh, you lied to investors about the risks. Yes, of course. I pointed that out over a year ago. I did a debate that hundreds of thousands of people saw on YouTube in which he basically admitted that he was running a Ponzi. I called him out. I said, you're taking all this risk with your deposits. And he said, no, we're not taking any risk. Well, why didn't the state of New York do something back then? I mean, before all this money was lost, why did they wait till everybody lost all their money to charge him with doing what was obviously going on a year ago? I mean, all these frauds were there, but then no one cared. The government ignored it. Now they're going to say, oh, now we need more government. Bernie Madoff got away with his Ponzi scheme for more than a decade. I'm not sure it was 20 years or how long he did it. But one of the reasons he got away with it for so long is because he was protected by government regulators. The SEC, FINRA, they protected him. They created a cloud of legitimacy. A lot of people didn't do their due diligence because, well, I mean, he's being regulated, he's being audited. I mean, if he was doing anything wrong, the regulators would have said something. So people's guards were lowered by the veneer of government. Government steals a lot more from investors than they're protected from fraud. There's a lot more fraud because of government. A lot of people can't even get professional advice anymore because it's so expensive that the minimums now are so high because it's so costly to comply with these rules and regulations that the small investor can't get any quality help. And so they're victimized by fraudsters because of government. If it wasn't for government, it would be a lot easier for honest investment advisors to work with smaller investors. But the government has priced them out of the market. And every once in a while, they nab somebody. Oh, yeah, we caught this guy. But they protect a lot more guys than they catch. And there's a lot of crime being committed that wouldn't be committed without all this government. We should get rid of the SEC. We should get rid of FINRA. The original Ponzi, Charles Ponzi, was around 1900. There was no SEC. There was no FINRA back then. We didn't get that. We didn't get the SEC until the 1930s. It was part of the Socialist New Deal. The New York Stock Exchange started in 1792. We had 140 years with no SEC. And there was a lot less fraud then than there is now. But Charles Ponzi didn't even pull off his Ponzi scheme for a year. The whole thing collapsed without any government. It collapsed. The media called it out. Investors figured it out on their own. And that's what shut Ponzi down. No governments were needed to do it, but Bernie Madoff stole a lot more money and got away with it for a lot longer precisely because of all the government agencies that were protecting him. So it's unfortunate. I know we're going to get a lot more regulation now because of the fraud in crypto, and it's going to end up hitting the honest investment advisors or broker-dealer community. It's going to drive more small firms out of business. It's going to drive up the cost of providing investment services. And that's what the government does. And that's great for the huge investment houses because there's less competition for them. They can afford these higher costs. But what's also going to happen to the crypto space is all this new regulation that's going to come in is just going to further drive up the cost of transacting in it, undermining the reason for its existence. As inefficient as it is right now, it's going to be even worse once it's subject to even more regulation. And I think that the institutions are not going to want any part of it. I mean, there was this drive in 2021 to sucker in the institutions, based on FOMO. Hey, you got to get in on this because otherwise you're going to miss out. But the ones that got in on it, have gotten killed. And the ones that, avoided it are glad that they dodged the bullet. And so I don't think there's going to be any push now for any institution to have any exposure, even 1% of their assets in crypto. So I think pretty much everybody who wants in on crypto is in. How do they get out? Where who are they going to sell to? That is the problem with crypto, because you can't spend your crypto. You have to sell your crypto. And, a lot of people are getting laid off. Whatchamacallit today, Barry Siebert's company, Genesis just laid off 30% of their workforce. This other company that's collapsing, Silvergate, the bank out in California, fired 40% of their workers a couple days ago.
I think they were connected to FTX actually.
Well, again, it's very incestuous relation, with all these companies. And they all helped push up the bubble on the way up. It was all this credit and all this nonsense that inflated the bubble, and now it's deflating. But when all these workers lose their jobs, how are they going to pay their bills? Well, they're going to sell their crypto. That's probably what they got. I mean, my guess is that the people who worked in crypto were all in on it. They drank the Kool-Aid. They not only worked for crypto, they had a wallet full of this stuff. But when they go to the grocery store, they don't want Bitcoin. When they pay their rent, their landlord don't want Bitcoin. And now that they don't have a paycheck anymore, where are they going to get the money to pay these expenses? Well, they got to sell their crypto. All right, well, who's going to buy it?
Yeah,
that's the problem. This whole thing is going to implode in 2023.
Yeah, I firsthand experience. I used to work at Real Vision, and I can say firsthand, a lot of the employees were exactly like that. I was luckily a fan of your podcast, so I never got into it. But there were employees who would every paycheck they would put most of it into crypto. They had like an automatic buying setup where, so that's very true. A lot of these people who work in that industry do own crypto. So you covered a lot of stuff there. One thing I wanted to note is what you said about regulators always kind of being behind the ball. Like, private actors are usually the first to discover the fraud. And like kind of how you did with Mashinsky. I was speaking to a short seller, Mark Cajotes, who was one of the first to notice the red flags about SBF and FTX. And one of the things he said is that in his experience, basically, it's always the short sellers who uncover fraud, and then the SEC just kind of comes in after. Enron is a great example of that. I think Jim Chanos was the first to point that out, and then afterwards regulators come in. So it is an interesting point. It's like if the short sellers point it out, then you can convict these people for laws that they've broken. You don't really need the preemptive regulation of the SEC and FINRA.
All the additional regulation does is punish the honest people and customers. I mean, a lot of the customers hate it. I mean, the stuff that we have to make customers go through now, it's very frustrating. A lot of times they blame us. They blame the firms. It's like, no. This is the government. The government is forcing us to do this to protect you. and you can't opt out of the government protection. You can't just say, look, can I just sign a form and just say, hey, caveat emptor, let me, no, for your own good, you have to do all this crap and I have to charge you for it. And then we get more and more bureaucrats, and that's what's coming, because whenever there's a big loss of money, the government is always trying to blame somebody for it. They never accept responsibility, especially the Fed. And then it's like, well, what's the solution? What are you going to do? Oh, we're just going to make government bigger. This just proves that we need even more regulations, And what it actually proves is we have too many regulations. We need more free market competition. That's what we need. I mean, market-based regulation is much better than government regulation. More effective at uncovering the frauds. They get uncovered quicker. Less money is lost. And the good actors are rewarded. What does the government do? I mean, they bail out the bad actors. Look how many firms were bailed out in 2008. They should have been able to go bankrupt. That would have been a good lesson, and the firms that did the right thing would have benefited from their reckless competitors going out of business. Instead, they got subsidies from the government. So their reckless competitors that should have gone bankrupt got even bigger. And now they've been able to make the same mistakes on a bigger scale thanks to the government. The free market would have provided a much better solution.
I think the option to opt out is a really interesting idea, and that would be pretty cool. If they
I've said, if let's say membership in FINRA was optional, if you could say, look, because it's a private company that the government requires you to join, unless you become a member, then you can't be a broker. They do the same thing with law, right? Well, unless you're a member of the bar, you can't be a lawyer. Well, why not? Who says? I mean, Patrick Henry wasn't a member of any bar. He was, a famous lawyer, but you couldn't hire Patrick Henry today because he has to be a member of this government-approved organization. Why? It should all be voluntary. I should have a right. Look, this is my stockbroker. I know he's not a member of FINRA. I don't care. Right? I don't need that protection. I trust the guy. It's like I can't even work with my own mother, right? If I wanted to have my mother as a client, they'd say, well, you can't manage your mother's money unless you become a stockbroker. If you're going to charge, well, I'm going to rip off my own mother. I mean, is that, it's like there is no leeway. You get, I guess even this, I guess you got to get registered in all the various states, even if you're in one state, well, you're not in this state, all the crap that you have to do in order to do that. But it's not just brokers. I mean, look at all the occupational licensing laws that exist. You can't cut hair unless the government licenses you. Why do we need protection from bad haircuts? I mean, how about I get a bad haircut, I don't go back. That's all the protection I need. I don't need, the guy doesn't have to have a certification from the government that says he can cut my hair. I can figure that out on my own, right? You need a government license to be a florist. What? I have to be protected.
That's true. There's a federal license for that?
No, these are local licenses.
Oh, okay.
But it's the same concept. Like the government thinks they got to license you. Why? I mean, what's the problem? I get a bad floral arrangement. I mean, how's that gonna? Oh, okay. I don't like the way you arrange these flowers. I'm gonna go someplace else next time. I mean, competition is what gives you a good haircut. Gives you a good floral arrangement. We don't need these stupid licenses, but all they do is run up the costs. We don't have as many barbers. We don't have as many florists because of licensing. We don't have as many brokers because of licensing. So we have less competition. We have less diversification of opinion. The market is less robust because of all this government intervention. And but that's what we're going to get. That's what government does. It's like a cancer. Government just grows. It just wants to get bigger and bigger and bigger. That is the problem with government because it wants to get bigger, but the bigger it gets, the weaker the economy gets because it sucks the life out of the economy. It's a parasitic relationship. I mean, government could be good to the extent that it can be kept really, really small. That's why, the founding fathers said government is a necessary evil, right? They knew it was evil, but if you could just contain it, which is what they tried to do with the Constitution, keep it really small and bind it in the chains of the Constitution. But unfortunately, at this point, the chains are gone. I mean, the government does whatever the hell it wants, and the Constitution is a meaningless document that we pretend still exists, but in practice, it's not doing what it was designed to do because it's completely ignored.
And one thing I've heard you talk about is that a lot of these FINRA especially, it's really hurting the small investors because it makes it not profitable for someone like you to work with a small investor because there's the liability, there's the paperwork. And that's why there's a lot of these minimum investment requirements where people then have to go use robo advisors and stuff like that.
Yeah, look, it's very difficult. Nobody wants to solicit recommendations to a small investor. It's way too risky, and you can't charge them enough, honestly, to cover your costs. The only people who can work with small investors and make money are crooks, because they overcharge them, they rip them off, and because they can't go to somebody who's honest, and the crooks get away with it because the regulators are too busy policing all the honest people, making them do a bunch of worthless, unnecessary stuff. I don't need governments to protect my clients. I'm going to protect my clients because they're my clients, and I want to protect them because that's good business for me, right? The more, I make more money if I have more clients. I get more clients if they send me referrals, if they're happy, right? I want my clients to do well. Nobody wants my clients to do well more than me. So I don't need the government to come in. Now, does that mean there aren't some people who cut corners and who might steal? Yes, there's always going to be people who will be criminals in every profession. But fortunately, the criminals don't get that big without government. I mean, you steal from your customers, and then you don't have any customers anymore, and then you're out of business, right? And there's also a value of reputation. There's brand. I mean, companies, if you have a good reputation in the marketplace, a brand that people trust, that is very valuable. And you need to protect that brand. And you don't protect that brand with criminal behavior. I'm not going to poison my customers. If I'm running a restaurant, I don't need the health department to make sure that my food is healthy and my customers don't get sick. The last thing I want as a restaurant owner is my customers getting sick. They're not going to come back, and they're going to tell their friends, I ate at Schiff's restaurant and I was, in the bathroom. No one wants that. I don't need, so without government, we'd have a much more efficient economy. Competition, a reputation are what we need. The bureaucrats are easily corrupted, bribed. You get all these regulators get captured by the industries they regulate, and they get turned around, and they're used to cartelize the industry and and exploit the customers, all under the guise of government protection. It's just a racket. But unfortunately, the racket's not going to end. Nothing that I'm saying is going to happen. We're going to get more government. We're going to get more regulation. We're going to get more licensing. And all of it is going to lead to a lower standard of living. And the people aren't going to know why. Why is it that in America today, two people have to have a job and a family, and they still can't make ends meet? When 50 years ago, a guy without a high school diploma could earn enough money to support his wife and 4 kids. And he didn't need a credit card. Didn't need to go into debt. What's happened with all our science and all our technology? Why do we have to work harder for less? That's because of government. People just haven't made the connection.
Yeah, that's an interesting point about people not really knowing why, because it's so far removed, it's so abstract. That was a great talk. We got a bit sidetracked. One last question I had meant to ask you on Bitcoin, to see if I can get you to admit that there is some utility involved. So I actually agree with you that it's not an inflation hedge with all the substitutes. And I get your main point, I guess, of why it's not a commodity or an inflation hedge is that there's no inherent utility. But I just wanted to press you on this one thing to see if there is utility. There was a story in the New York Times about this Venezuelan guy. He was escaping the authoritarian regime, but the border agents would just confiscate your stuff if you tried to leave. So basically, he put it all in Bitcoin. He left over the border and was successful in taking some of his net worth with him. So I know that's a niche example, but is there, if the state that you live under becomes more authoritarian, Bitcoin's more maneuverable, it's more transactable,
except there are better alternatives. Because let's say I am escaping a corrupt regime and I'm able to get my Bitcoin out of the country. But what if it just so happens that when I go across the border, there's a Bitcoin crash, and what I've been protecting and what I just smuggled out of the country just lost its value because there was a crash, right?
Right, but it's better than leaving with nothing.
Yes, that's true, unless it crashes to zero. But what if I could take something across the border that is just as easily to to transport, right? But has actual value and is not going to fall, right? See, what if there's other cryptocurrencies that are backed by real assets? Let's say backed by gold. Let's say I can go online and I can buy on an exchange, or I can just, transact with somebody else. And instead of taking Bitcoin, I can take a gold coin, a tokenized gold coin that represents ownership of gold sitting in a vault in Switzerland, right? And that vault's there in Switzerland, and all I own is a token that is a digital representation of that ownership. And I can have that on my cell phone or my hard drive or whatever. And now I have a real digital currency, not a fake digital, fiat digital currency. And so that solves the problem right there. When you have you keep gold in it, and now you introduce blockchain and you tokenize the ownership of that gold, and now it's on the internet. And I can take, let's say the gold coin, the token is a gram of gold or an ounce of gold, whatever it is, doesn't matter what the denomination, but it's divisible. I can divide it down to the point where I can buy a cup of coffee with gold. That was the original criticism. The Bitcoin guys 10 years ago, oh, you can't buy coffee with gold, you can buy it with Bitcoin. Well, try buying it with Bitcoin. It's too expensive. None of these coffee merchants want to get paid in Bitcoin, but they can be paid in gold. I mean, anybody would accept these gold tokens once they really start to circulate, because gold works as money. Gold on the blockchain is faster and cheaper to use than Bitcoin, except it's dependable. You know what it's worth. It's not going to crash. So just like Gresham's law, good money, bad money drives out good money. In good crypto is going to drive out the bad crypto, meaning Bitcoin. When people really have an alternative, that's what they're going to go to. Now, the reason you haven't seen a big push, let's say, to a gold-backed crypto yet, is because people didn't want crypto to affect transactions, at least most of the people. They wanted crypto to get rich, and there was no get rich quick story with gold. Gold's not about getting rich quick. It's about staying rich if you're already rich, or not getting broke. It's about preserving what you have, not going to the moon and getting your Lambo. But when all the people who were looking for a moon ride to Lamboville, when they end up in the poorhouse instead, and it's no longer just get rich quick. When you get right down to the real promise of a alternative to a fiat system run by central banks, and you realize that, wait a minute, the private sector has an alternative to fiat currency, and that's real money. And we can introduce real money into the economy using the blockchain, using all the stuff that everybody liked about Bitcoin. The only difference is, yes, you need a third-party custodian to hold the gold. Well, so what? Competition for custodians. The most reputable custodians will have the coins that are the most readily acceptable in the market and will win out. Just like back in the olden days, when we went from gold to paper money backed by gold, people at one point just transacted in gold coins. But then they started using paper that was backed by gold. Well, which paper would you accept? Well, from an issuer that I trusted, whether it was a commercial bank or some other reputable blacksmith or whoever who had a good reputation, I would take their paper. There's nothing wrong with trusting third parties. They can be vetted, they can be independently audited, they can be insured. So now the insurance companies are going to vet them and audit them. And people buy products. You buy life insurance, you buy auto insurance, you're betting on a third party. I mean, your policy is only as good as the third party's ability to pay.
I think that makes sense. It's just at that point, why you don't really need to involve blockchain. You know what I mean? Why not the third party who's issuing you the gold token? Why not just let them issue it on their own private server?
Yeah, you could have a private blockchain, or you could have a closed loop system. The question is, will blockchain?
The reason blockchain's involved is to make it decentralized. If at the end of the day, the thing that has value is at a third party holding system, you might as well just let them issue their own tokens. It doesn't have to be on a blockchain. Because if you trust
the blockchain, the blockchain is just
not to manipulate the ledger.
That's mainly just so maybe it can trade on various exchanges or travel on different blockchain networks that already exist, maybe making it easier. But yeah, no, you don't necessarily need it. but maybe it makes it more efficient. I mean, if not, then there's no real benefit of that technology. But it could certainly be utilized. And if it's more efficient, then they'll be on the blockchain. If it's not, then ultimately it won't be. But the main barrier that you're going to have to honest money being created privately is government, because government hates competition. And governments right now have monopolies pretty much on money. And they don't want to give that up. But, look, the government had a monopoly on the mail, and they allowed FedEx. I mean, they still can't deliver, regular mail, but, they could do shipments. At one point, they couldn't. And, so, Uber is around competing with taxi cabs that, were not very efficient because they were government regulated, monopolies in many cases. So they were inefficient and overpriced. And so the free market found a way to get in. But, we didn't always have fiat money. Governments created that. The private sector never would have created something that, idiotic. We created real money in the private sector. Gold was money. And we created real currency, which was currency backed by gold. Governments initially started with honest money, but then they came up with fiat money because they had the power of government to force people to accept it, and they could force you to pay your taxes in it. But, governments have been coming up with fiat monies for hundreds of years, and they've always failed. I mean, there is no example in history that you could point to of a fiat currency that was around 200 years ago that's still around. They're all gone. Now, yes, the ones that have been around for 50 years, yeah, they're still here. We've only been on a fiat system for 50 years. But 50 years from now, I don't think any of these currencies are going to be around in their current form. They will have been wiped out. And hopefully they'll be replaced by real money. But I think the initial push back to real money is going to come from the private sector. It's not going to come from the government. It's going to come from private sector demanding real money. And so merchants are going to want to get paid in real money, especially when inflation starts to run out of control. They're not going to want your paper. They're going to want real money, and so they'll want to get paid in gold. And an efficient way to do it is using the internet, using blockchain or some other technology where I don't have to physically hand you gold. I can just transfer ownership of gold to you electronically while it's stored safely in a vault somewhere.
Right. So I would agree with you and concede that gold is much better money than these cryptos are. If you're going by the definition of money that I think Carl Menger came up with the different attributes of liquidity, I guess I'm just trying to ask you, is there some utility in that where you don't need the counterparty? Is there some benefit to the maneuverability, the transferability, and you don't need that third party? If you're in a dire situation like that Venezuelan was, there's really nothing other than that he could have done.
Well, but the problem is, all right, you got Bitcoin, and there are thousands of other cryptos that can do the same thing as Bitcoin.
Sure.
Bitcoin is not unique. Yeah. And is that benefit worth the trade-off in that there's nothing behind Bitcoin? So yes, the reason that you can do all this stuff with Bitcoin is because there's nothing there. So the reason I can do all this without a third party is because there's nothing there, right? So I can transfer you my nothing, right? And you can receive that nothing. But if I want to transfer you something, then there's got to be a third party involved that has the something. So the trade-off is we can eliminate the third parties, but then we eliminate the something. And we all have to have confidence in nothing. And, I think that I'd rather trust a third party than trust that nothing is going to be valued as something when it's nothing, because people could wake up and the price of Bitcoin could crash. But if I have a gold-backed token, the only thing that can go wrong is somebody steals the gold. It's not there. So I could limit that risk by diversifying and just picking quality custodians that I can trust, just like I trust people, for my life insurance or my fire insurance or, all the other counterparties that you trust based on their reputation, based on years or decades of being in the business, right? And I would rather put my trust in a private company that has a good reputation to protect than put my trust in government or put my trust in just some faceless a network of miners, because there's still people back there, that you need, doing all this. And of course, all this Bitcoin mining costs a fortune. I mean, they use a tremendous amount of energy to maintain this whole thing.
Yeah, no, all good points. I do agree that you're transferring nothing. I guess I'm just thinking, if you're in a very dire situation where you don't have access to a reputable third party, gold is great, but like when FDR banned private gold, I know he didn't, according to you, he didn't really actually go to people.
Well, he made it illegal, but they didn't send
something like that
government.
happened.
They didn't send government agents to people's houses and like ransack them. They didn't turn people over and shake them to see if they had any gold in their pockets. So a lot of the gold coins didn't get.
It'd be in an easier situation to transfer your wealth if you had a crypto, even though it's super volatile. Even though
I mean, look, gold is not that. Look, I can put a few gold coins in my pocket. I can go across the border. I could use them to bribe the guards to let me across. I mean, you can still smuggle gold out a lot easier than a lot of other things. But again, you can have a wallet full of tokens backed by gold. And I'd rather have gold in my crypto wallet than Bitcoin. Because it's just as portable, it's just as divisible, it's just as fungible.
As long as the counterparty is in some other jurisdiction, I guess that's
I'm not gonna take account. I'm not gonna have my gold in like a country that I don't trust.
Right.
With a party that I don't trust.
Yeah, it's an interesting idea. Maybe it's something your company could roll out.
Companies are doing it. Yeah, look, more people are going to do it, but it's there hasn't been a big demand for it yet. There's going to be, because recently, look, why do you need that? Dollars work fine, euros work fine, but once we get into an environment of much higher inflation that's kind of baked into the system, then the dollar's not going to really work anymore for a lot of people. They're going to look for an alternative. And you already see that, like in some countries where their currency is already inflating a lot, big inflation. Let's say in Argentina or someplace. You go to a lot of these countries, and there are black markets all over the place where you can get better service and get better prices and better exchange rates if you use U.S. dollars, right? And so I think that's going to happen in the United States. But when the dollar is no longer good, the euro is what are people going to use? Well, gold is the most likely alternative, to that. When you're, because if you don't like the peso, okay, I'll take the dollar. I'll trade up to the dollar. But when you don't like the dollar, I mean, what paper currency are you going to have confidence in? I mean, shit, if the dollar is no longer trustworthy, why should I trust the euro? Why should I trust, the yen? I mean, even the Swiss franc or some of these currencies, people are so, well, if the dollar can go, anything can go. So let me go back to real money. Let me put my trust in gold. And as inflation really starts to accelerate and gold prices really start to rise, merchants are going to realize, hey, I don't even want to sell my goods for paper because then I have to buy more inventory. And what if I can't even afford it? The prices are going up so fast. If I accept paper, I won't even be able to replace what I just sold. So the merchants might say, look, you want to buy these products, pay me in gold. So at least I know, okay, I just got gold for my product. I don't have to rush and spend the money right away. I can hold on to the gold for a while because, it's a hedge.
All right, makes sense. That's the thesis right there. Gold, inflation, the dollar's going down, and gold will likely go up as a result. Peter Schiff, thanks so much for joining us here at Epoch Times, and hope 2023 turns out a bit better than you predict, at least in the real economy. But
well, it's going to be tough for some people, but it'll be good for others. I mean, inflation is a massive transfer of wealth. There's going to be winners and there's going to be losers. So I'm just hoping that at least I'll be a winner, and the people who are working with me will be winners. And so I would suggest, again, people contact my company at Europe Pacific Asset Management, so we can take a look at your portfolio and get it reallocated for the reality that we're living in now, not the fantasy that a lot of people are still trapped in. And remember to follow me on social media, on my YouTube channel, Twitter. I'm doing a lot of tweeting these days now. I'm almost at 1 million followers, so the word is getting out. So you should follow me there. And I'm also, on Instagram and Facebook and these other social media. So help me spread the word, because I'm trying my best to educate people about free market capitalism and sound money, and get them to see through what they're being spoon fed from the traditional media about socialism and central banking. Because I'm one guy, and there's a few others like me, but we're in the minority, so I need help to get the message out there.
Thanks, Peter. We appreciate you getting the message out on our platform as well.
All right, take care.
So.